Something historic is happening in Germany. Both the leading right-wing party and the leading left-wing party have joined forces to cut back on the welfare state. In healthcare alone, 20 billion euros will be cut in 1 year, with another 20 billion to follow by 2030. The reason? War.
The German government announces drastic cuts to the welfare state to reduce the deficit and pay for rearmament. The coalition of Christian Democrats and Social Democrats agrees to reduce healthcare spending by 38 billion euros by 2030, despite strong social opposition and opposition within their own parties.
Just as you heard, less healthcare to pay for more bullets and guns. Or at least that's what has drawn the most attention, although, as we'll see later, the situation is much murkier. In any case, why do this right now? Is the military in such bad shape that it has to cut back on something as important as healthcare? Well, we could give you a lot of data, but I think it's enough to say that in recent years, we've seen the German army conducting military exercises with broomsticks instead of real weapons. I think that says it all. The fact is that for decades, Europe has delegated its security to the United States, basically because there wasn't really any threat. But now, with Putin turning the tables and Uncle Sam no longer being such a reliable ally, everything has changed. Without going any further, we've seen the US remotely deactivate some weapons sent to Ukraine, and in recent weeks, Trump has threatened to reduce and even withdraw the US military presence in Europe. Although, as we saw in VisualEconomik, that move would be bad above all for themselves.
U.S. to cut troop levels in Germany by 5,000 amid Trump spat with Merz.
In any case, not all countries are equally concerned about Putin. Because do you know what variable best explains what percentage of their budgets European countries are allocating to defense? Basically, the distance to Moscow. Well, keeping all this in mind, on VisualEconomik, we've been asking a few questions. Is it possible that military needs could end up critically undermining the German welfare state? Could this problem spread to other European countries in a similar situation? We'll explore this topic in this video. But first, if you're interested in the world of investing, if you want to learn how to manage your savings, protect yourself against inflation, and figure out how to make money beyond your day job, well, I've got some good news for you. At Visual Factory, we have created the Visual Factory Club, a newsletter where every week we send out free content focused on essential financial education, the ABC of what everyone should know to understand the stock market, financial markets in general, investment platforms, how to assess investment opportunities, and which markets may have more or less potential. Because of course, if you want to invest your money so you're not at the mercy of your country's economic instability, you at least need to understand the basics of the financial world. In the Visual Factory Club, you'll learn all of this completely free of charge. Through the link below and this QR code, you can sign up for the club and start receiving the upcoming editions. What's more, when you sign up, you'll receive a dossier where I explain in a clear and simple way the most essential investment concepts, what multiples or the PE ratio are, what indices are, ETFs, derivatives, funds, EPS, you get the idea. After that, every week you'll receive additional materials and market analysis to help you stay informed about what's going on. And by the way, the sooner you sign up, the better. Since we send each episode of the series by email and every edition is unique, if you're not subscribed, you might miss some of them and you won't be able to access them later. VisualEconomik community, these cuts cannot be understood without the broader context of Germany's current situation, which, in many ways, resembles that of the rest of Europe, yet is unique in some respects. In particular, two things stand out here. The first is that it's a country very concerned about its public deficit, when the truth is, its public debt is barely around 60%. And the second is that it's also one of the countries most committed to rearming itself in the face of Putin. And to achieve this, it has put a financial bazooka of 1 trillion euros on the table to be spent over the next decade. Now, in order to spend that much and keep things from getting out of hand, two things are needed: a combination of cuts and debt. As for the cuts, we've already seen that the main victim will be healthcare. But why healthcare? Couldn't this be a worse cure than the disease itself? Well, the problem is that in Germany, healthcare operates on a contribution-based system, just like pensions. They basically have a separate accounting system. Workers contribute to a sort of piggy bank that entitles them to basic health insurance. The problem? Well, the same one as with pensions. There isn't a single piggy bank for each worker, but one for everyone. And there are far more people spending money from the fund than there are people contributing to it, so the government has to make up the shortfall. One of the main causes of this structural deficit is that a worker's spouse is also entitled to healthcare healthcare, even if they haven't contributed a single euro. So the CDU and the SPD have agreed to raise contributions by at least 2.5% for those who do work. Now let's be honest, the main problem with the German healthcare system isn't couples where only one partner works, it's demographics. In Germany, about 350,000 fewer people are being born than are dying each year, and by 2035, it's estimated that 1 in 4 Germans will be over 67 years old. Yes, you heard correctly, 25% of the population will be well past retirement age in less than a decade.
August 23, 2025. German welfare state can no longer be financed. German Chancellor Friedrich Merz has called for a reform of Germany's social welfare spending while ruling out tax increases on medium-sized companies.
So the problem can no longer be solved by cuts alone. The solution, that's where public debt comes in. To that end, Merz has approved a reform that excludes defense spending from the constitutional debt ceiling. However, it's one thing to pull off tricks to make taking on debt legal, and quite another for the market to actually lend you that money, and to lend it at the rock-bottom rates that European politicians are seeking. Because if that doesn't happen, and your borrowing costs end up skyrocketing, then the snowball will just keep getting bigger and bigger. And an ever-growing public debt snowball, while you have an aging population with a higher percentage of retirees, is not an ideal situation. Be that as it may, there's a catch to this whole Merz plan. Yes, a huge catch. Because the claim that Merz has a €1 trillion package to rebuild his country is a lie. In reality, it's only half that amount. The other half is spending on infrastructure and climate change. Want defense? Well, pay for the Brussels agenda. Although, to be fair, this seems to have been a bribe to get the other political parties to approve military spending. Luckily for them, Germany has a secret weapon, Eurobonds. That is, instead of taking on debt of its own, it uses joint debt from all of Europe, which in theory should be cheaper and safer for investors. However, Eurobonds, as they've been proposed so far, have been a huge disappointment, both economically and politically. In 2025, Euro debt accounted for only 2.1% of the country's GDP. Clearly, they are not the solution that Merz and his governing coalition so desperately needed to balance the books. Does this mean then that Germany won't be able to pay for rearmament, or half rearmament, half climate agenda, with debt? Well, no. I mean, look, it will be able to pay for it, as I was saying a moment ago. What's really concerning is the cost. And the truth is, the country's political uncertainty doesn't help either. Politics in Germany is in utter chaos, which is scaring off investors. And if we add to that the aging population and spending that just keeps increasing, well, you tell me. And in a way, that's one of the reasons why the cost of German debt is skyrocketing, which in turn increases the deficit and forces them to issue more debt. And so the cycle begins anew. In other words, Germany has its finances in order, but could be on the verge of plunging headlong into the debt spiral, all too familiar to the countries of southern Europe. So, what solution is left if not to cut spending even further? Well, a good solution would seem to be to grow the economy further, and then be able to collect more taxes. However, as you all know, since the COVID crisis, Germany has gone from being the engine of Europe to its sick man. The country is economically in the ICU. In fact, the GDP data is so bad that the Bundesbank has to zoom in so we don't see a flat line. And that's in 2025, because in 2023, the economy contracted by 0.7%, and in 2024, by another 0.5%. But yes, 2025 was somewhat better, with 0.4% growth and plenty of optimism for the coming year. Companies like Volkswagen were stepping up their game, as we've already told you on this channel. And overall, German industry was receiving a record number of orders. Everything pointed to 2026 being a great year for this country. But what ended up happening? Well, nothing good.
Germany's very weak start to 2026 puts recovery in doubt. Trade data for January showed a 2.3% monthly decline in exports and a 5.9% drop in imports.
The optimistic scenario for this year was that Germany would grow by 1%. And I say optimistic because that's half of what it should grow by if it were a healthy economy. But a few weeks ago, the Bundesbank estimated that the country will grow by 0.5%, or in other words, that it won't even reach that figure. And it remains to be seen if things don't end up even worse. And here we need to make one thing clear. As we've already told you would happen on VisualPolitik, the war in Iran has done quite a bit of damage to Germany. After all, the German economy is heavily dependent on industry, and that means it depends on electricity. But of course, since Angela Merkel declared war on nuclear power, and no other politician has backed down, the price of electricity in Germany depends heavily on gas, which of course is one of the hydrocarbons that has become most expensive following the blockade of the Strait of Hormuz. Now, that hasn't been the only problem. Do you remember those record orders for German industry? Well, they were a very exceptional occurrence back then. Now, orders are below last year's figures, and both domestic demand and demand from other European countries have plummeted. And as if all that weren't enough, insolvencies are at record levels since the 2008 crisis. Keep in mind, we're talking about 30% more bankruptcies than before the pandemic, and the worst part is that this percentage is rising little by little. And what does all this mean? It means that the job market isn't exactly cause for celebration either.
The latest leading indicators show no signs of a labor market recovery in the coming months, either. The IFO employment barometer remains deep in negative territory despite a minimal improvement in the overall indicator of late.
The German employment rate has been falling for 11 months. Just when a strong economy was most needed to foot the bill for everything, the economic data is getting worse. In reality, the only thing that seems to be rising is civil servant salaries. Look, Germany is a highly decentralized country, so a large portion of spending is carried out by local governments. The €1 trillion spending package over 10 years that Merz has put on the table is very striking, but in reality, there's something that could be much worse for public finances: the debt of these local governments. It's supposedly capped, but in practice, it is subject to many more nuances. In 2023, they had barely any deficit, less than €5 billion, but 2025 ended with a deficit of 30 billion, 6 times higher in just 2 years. How could it have grown so fast? Easy. While the economy grew by only 0.5%, public sector wages rose by 7%. But social spending, basically healthcare and pensions, rose another 6%. Or to put it another way, it grew 12 times faster than the economy. And in a sense, it's to be expected. The German economy is likely to suffer a whole lost decade. And when the pie doesn't grow, the fights over the crumbs begin. Everyone wants to secure their share, which is why public sector workers have pushed for such a high wage increase. In the end, it looks like working families will end up footing the entire bill, paying higher contributions in exchange for fewer government services. Previously, a worker's contributions covered their partner's healthcare. Now these contributions are going up, and on top of that, if you want them to cover your partner, you'll have to pay an additional 2.5 percentage points. The thing is, debt as such isn't a very important figure. What matters is debt as a percentage of GDP. If things are going well, even if you go into debt, you can lower the debt level by increasing GDP, earning more, and collecting more in taxes. But right now, Germany has neither. Do you understand now why the CDU and the SPD have joined forces to cut spending on something as sacred as healthcare? Germany is at a point where it must make cuts, or the numbers won't add up. In conclusion, what we're seeing in Germany is a combination of two factors. On the one hand, government spending is growing by leaps and bounds, driven by demographics, military rearmament, and the political concessions that must be made to reach agreements on these two issues. And on the other hand, the economy isn't growing fast enough to pay for this spending spree. These are two problems that feed into each other. To pay for this spending, taxes must be raised, and that damages the economy. And with a damaged economy, people start fighting to secure their share of the pie. In practice, that means more pressure to raise taxes even further on everyone else, which ends up damaging the economy, and it's back to square one. It's a vicious cycle. But now that we've reached this point, it's your turn. Do you think these healthcare cuts will ultimately be approved? Do you think they're a good idea? Or would you prefer another solution, such as cutting military spending or raising taxes even higher? Will we see something similar soon in other European countries? You can leave your response down in the comments. And as always, don't forget that here on Visual Economic, we release new videos every week, so subscribe to this channel and click the bell icon so you don't miss any of our updates. If you like this video, hit like, and I'll see you in the next one. Take care. See you next time.